Have you ever been right about a stock but still lost money? You saw the move coming, you placed your bet, the stock went your way, and your position still expired worthless. It's a uniquely frustrating experience, but it's common. That's because you didn't just bet on direction, you bet on a deadline. In the markets, there's a price on what and a price on when, and the clock is often the more ruthless opponent. Picture this. A stock is trading at $100. You buy a call option, giving you the right to buy it at 105. You pay a $2 premium for this right, and it expires in 30 days. The stock drifts up. On expiration Friday, it closes at 104. You were so close, but your option is worth zero. The move didn't arrive in time. Why did it lose everything? Because an option is a contract with a finish line baked into its DNA. Hitting 104 is not the same as hitting 105. Close doesn't count. In the world of options, being late is functionally identical to being wrong. The deadline won. Before we get into the mechanics, understand that this used to be a chaotic, bespoke world. Before the 1970s, options were custom contracts traded between institutions. There was no central exchange, no standardized pricing, no guarantee the other side would even make good on the deal. It was the Wild West. And then, in a single year, everything changed. So let's define these modern tools. A call option gives you the right, but not the obligation, to buy a stock at a predetermined price, on or before a specific date. A put option is the opposite. It's the right to sell a stock at a set price by a set date. For this right, you pay a fee, known as the premium. That premium you pay is made of two distinct parts. First, its value right now, if you exercised it. That's called intrinsic value. But the second part is the magic ingredient, the value of what could happen before time runs out. That is its extrinsic, or time value. Intrinsic value is fact, time value is possibility, and you pay for both. A few more pieces of plumbing. In the US, a standard stock option contract typically represents 100 shares of the underlying stock. Most of these are American style, meaning you can exercise your right on any business day before it expires. Many broad index options, however, are European style. They can only be exercised on the expiration date itself, and they usually settle in cash, not shares. The revolution began on April 26, 1973. The Chicago Board Options Exchange opened its doors, offering standardized, listed options on just 16 stocks. Suddenly, anyone could trade these contracts on a central exchange. To make it trustworthy, the Options Clearing Corporation, or OCC, was formed. The OCC acts as the guarantor for every trade, ensuring that contracts are honored. The Wild West had been tamed and organized into a city. Just 1 month later, the second shoe dropped. In the Journal of Political Economy, Fisher Black and Myron Scholes published their option pricing model, with crucial input from Robert Merton. It was a landmark. For the first time, there was a mathematical formula to rationally price an option. And two of its most critical inputs were the time until expiration and the expected volatility, or bounciness, of the stock. Time and volatility weren't just feelings anymore. They were variables in an equation. Let's revisit that clean split. The premium is the intrinsic value plus the time value. If an option is out of the money, meaning it has no intrinsic value today, then its entire price is time value. You are paying purely for the chance that the stock moves favorably before the clock runs out. You're buying maybe. This brings us to the most relentless force in options, time decay. Traders call it theta. Think of time value as a melting ice cube. Every day, a little bit of it disappears, turning into water and draining away. If the stock price and its volatility stay perfectly still, your option will lose value every single day, guaranteed. It is the rent you pay for holding the right. Where does this ice cube melt the fastest? Usually for options whose strike price is closest to the current stock price, the at-the-money options. This is where the uncertainty is greatest. The outcome is a coin toss. Because the maybe is biggest here, there's more time value to lose each day. Options deep in the money or far out of the money have more certain outcomes, so their time value and thus their daily decay is often smaller. This decay doesn't happen in a straight line. It accelerates. For an option with several months of life, theta decay is a gentle slope. But as expiration approaches, that slope becomes a cliff. In the final week, and especially the final days, an option can lose a huge percentage of its value from time decay alone. You can feel like a genius on Monday and be wiped out by Friday, even if the stock barely budged. The other half of maybe is volatility. The option market doesn't just look at past price swings, it makes a forecast about future bounciness. This forecast is embedded in the option's price, and we call it implied volatility. It's quoted as an annualized number. So, a 20% implied volatility suggests the market is pricing in a move of about 20% over a year, up or down. As a rule of thumb, this translates to a much smaller monthly move, around 6%. Higher implied volatility means more expensive options, all else being equal. It's simple logic. If the market expects bigger price swings, the chances of an option finishing in the money are higher. That inflates the maybe factor, so the time value gets more expensive. Same clock, bigger potential waves, bigger price for the surfboard. But not all volatility is priced equally. There's a feature called skew. For big stock indexes, puts, which protect against a downturn, often trade at a higher implied volatility than calls at an equal distance from the current price. Why? Because institutions fear sudden crashes more than they crave sudden rallies. They are willing to pay more for downside insurance. That persistent demand makes puts relatively more expensive. The market remembers that stocks take the stairs up, but the elevator down. Here's a twist that catches many off guard. Volatility and time can overpower direction. A stock can actually fall, and your call option on it can rise in value, if implied volatility explodes upwards at that moment. The fear factor can temporarily be more powerful than the price move. The reverse is also true. A stock can rally after good news, but your call option can lose value. This is the volatility crush. Earnings announcements are a perfect laboratory for this. In the days leading up to a report, the uncertainty is enormous, so implied volatility gets bid up. Option premiums become inflated, pricing in a big potential move. Then, the numbers come out. The big question is answered. Even if the stock moves, the uncertainty evaporates instantly. This collapse in implied volatility can decimate an option's premium, even if you guessed the direction right. The maybe has vanished. For decades, options expired once a month, but in 2005, the CBOE introduced short-dated weeklies. Over the next decade, they exploded in popularity. Now, you can buy an option that expires in a few weeks, a few days, or even on the same day. Time became a high-precision, tradable variable. This change focused a huge amount of activity on very short time frames, making the market even more sensitive to the clock. These short-dated options are hypersensitive. With so little time left, small moves in the stock price can cause huge percentage swings in the option's premium. This extreme sensitivity is what attracts so much speculation. It's powerful leverage, but it's also a double-edged sword that cuts deeply when the clock runs out just moments before your target is hit. To manage these forces, traders use a shorthand known as the Greeks. Forget the math, just think of the concepts. Delta tells you how much an option's price is expected to move for every $1 change in the stock. A delta of 50 means the option will move about 50 cents. An option deep in the money behaves almost like the stock, with a delta near 100. One far out of the money barely budges with a delta near 0. Gamma is the accelerator. It measures how fast that delta itself changes as the stock moves. Gamma is highest for at-the-money options that are close to expiration. This is the source of that hypersensitivity. A small stock move can cause a big change in delta, which forces traders to adjust their hedges, which can cause more price moves. Gamma is the engine behind explosive feedback loop behavior, especially on expiration day. It makes price action jumpy and unpredictable. And we've already met the other two key Greeks. Theta is the daily cost of time decay, the rent, and Vega measures an option's sensitivity to changes in implied volatility, the anxiety meter. These four forces, delta, gamma, theta, and Vega, are constantly interacting. They are the physics engine that governs an option's price, with direction just being one input among many. If understanding these market mechanics is valuable to you, take a second to subscribe. We explain the wiring, not the hype. Now, back to the machine. So who is on the other side of all these trades? Often, it's a market maker or dealer. Their goal is not to bet on direction, but to earn the spread between the buy and sell price. When they sell a call option to a customer, they are now short. To neutralize their risk, they buy some amount of the stock. How much? Delta tells them. As the stock price moves, their delta changes, forcing them to constantly buy or sell shares to stay balanced. This hedging activity can have a strange side effect, especially on expiration day. If there's a huge amount of open interest in both calls and puts at a single, popular strike price, say $100, the stock price can seem weirdly drawn to that number. As the stock wiggles just above or below 100, dealers are furiously buying and selling shares to manage their gamma risk. This concentrated flow of hedging activity can act like a gravitational force, pinning the price to the strike. It's not a conspiracy, it's a traffic jam of incentives. With all these moving parts, you might think call and put prices could fly off on their own, but they are rigidly linked by a concept called put-call parity. It's a no arbitrage rule that says a call can be synthesized by a put, the underlying stock, and some cash. It's the bedrock that ensures the prices of calls and puts with the same strike. And expiration always stay in a rational relationship, no matter how wild the market gets. Let's bust a common myth. Most options don't end in a dramatic binary outcome of jackpot or total loss. The data from the OCC shows a different story. Historically, about 55 to 60% of option positions are closed out by traders before expiration. Roughly 30 to 35% expire worthless, and only about 10% are actually exercised. This tells you what they really are. For most professionals, options are risk management tools, not just lottery tickets. Exercising an American-style option early can feel like locking in a win. But for options on non-dividend-paying stocks, it's usually a mistake. When you exercise, you get the intrinsic value, but you forfeit all of the remaining time value, the maybe money. It's often better to sell the option itself to another trader and capture both, rather than throw the time value away. The main exception involves dividends. If a stock is about to pay a dividend, it can be profitable to exercise a deep in-the-money call option just before the ex-dividend date. You do this to capture the dividend payment, which you would otherwise miss out on. The trade-off is simple. Is the dividend you'll receive worth more than the small amount of time value you're giving up? Now for the stories. In January 2021, a rush of traders bought huge volumes of near-term, out-of-the-money call options on GameStop. The dealers who sold those options had to buy shares to hedge their delta. As the stock rose, gamma kicked in. Their delta shot up, forcing them to buy even more shares, which pushed the stock higher, which forced more buying. This vicious feedback loop, a gamma squeeze, showed how short-dated options could become the tail that wags the dog, driven by the mechanics of time and hedging. But time can be used for defense, not just attack. In the mid-2000s, Southwest Airlines famously used long-dated call options to hedge its jet fuel costs. They paid a premium for the right to buy fuel at a capped price for years into the future. When oil prices spiked dramatically into 2008, crippling other airlines, Southwest was protected. Their options became incredibly valuable. It was the exact opposite of a short-term gamble. It was strategic, long-term risk management. Sometimes, a time-based strategy designed for safety can create its own disaster. This happened in the crash of 1987. Many institutions were using portfolio insurance, a strategy that automatically sold index futures, a cousin of options, as the market fell. When the market started dropping, these automated time-sensitive selling programs all kicked in at once. They flooded the market with sell orders, accelerating the crash. The insurance became the source of the fire, a stark lesson in how mechanical, time-based hedging can create systemic risk when everyone uses it at the same time. You can still see timing effects in calmer waters. Watch a heavily traded stock on an expiration Friday with massive open interest at the $100 strike. As the 4 p.m. close nears, the price action often gets sticky, hovering just above or below 100. That's not new information about the company's future. It's the ghost in the machine, the concentrated hedging flows of dealers fighting their gamma exposure around a big, round number. So what's the takeaway? Options force the market to put a precise price on time. They reveal the market's collective guess on volatility. And the plumbing of this market, the hedging done by dealers, can create its own strange price action. Time isn't just a passive backdrop for investing. It's an active, tradable dimension with its own physics of decay and acceleration. In the market, your timing doesn't just affect your outcome. It has a price, and that price is always moving. A final, honest word. The real world is always more complex. Option pricing depends on interest rates and dividends, not just the factors we covered. Decay isn't perfectly linear. Hedging effects like pinning are not guaranteed. They depend on market conditions. And none of this is ever advice to buy or sell anything. This is the wiring diagram. Understanding how the machine works is the first step, the only step we take on this channel. If clear market mechanics are what you're looking for, you're in the right place. Subscribe for more deep dives into how markets really work. Drop a like if this cleared things up. We have a whole library on the channel. See you next time.